Cost of capital. In this reading, we will first discuss the cost of capital, what this means, and how to calculate the cost of capital. We then talk about the costs of different sources of capital, recognizing that there are three main sources of capital. One is debt, preferred shares, and common shares or equity. So we need to understand how to compute the cost of debt, cost of preferred shares, and cost of equity. We will then cover a few miscellaneous topics related to cost of capital estimation. Let us understand the basic concept behind cost of capital. Cost of capital is the rate of return that suppliers of capital require as compensation for their contribution of capital. Simplistically put, a given company needs money. The money that it raises is called financial capital. There are two primary sources of capital: debt, which is money coming from lenders, or equity, which is money that is contributed by owners. When a lender lends money to a company, obviously he is expecting a return. The return that the lender expects is a cost from a company perspective. So you need to understand this. When the investor, here we will talk about a lender, lends money to the company, the investor is expecting a return for lending that money. That is an investment return from the investor perspective, but from the company perspective, the company is receiving money and it needs to pay a return to the investor. From the company perspective, that is a cost. The other primary source of capital for a company is the money that is contributed by owners. Again, when owners contribute money to a company, they are also expecting a return. Simply put, this return would be in the form of dividends. And again, owners would expect a certain return, and that is called the return on equity. For the company, that would be a cost. Second point, a company will invest in a given project if the return is greater than the cost of capital. This is related to an item we discussed in the previous reading, where we talked about the IRR rule, and we said that we invest in a project if the IRR is greater than the cost of capital or the required return. Notice that we use the terms cost of capital and required return interchangeably. If for a given company, the overall cost of raising money from lenders and owners is 10%, this will be our cost of capital, or this will be the required return. We will invest that money in a project if the return on the project, or simplistically the IRR of the project, is greater than 10%. So if the return is 15% on a project, then it would make sense to raise money at a cost of 10% so as to engage in a project that will give us 15%. The third major point on the slide is that riskier projects will have a higher cost of capital. This is something we'll discuss later, but it is a core concept in finance that low risk projects will have a relatively low cost of capital, and higher risk projects will have a higher cost of capital. And finally, in terms of terminology, you will hear the term marginal cost of capital. Marginal means additional. So marginal cost of capital means what's the cost of raising additional capital. When we talk about investment return greater than cost of capital, we are really talking about the investment return being greater than the marginal cost of capital. Another related term, which is quite commonly used, is weighted average cost of capital, or WACC. And that is what we will talk about on this slide. How do we calculate the cost of capital? What we do is take the weighted average of the cost of capital from different sources. We have three primary sources of capital: debt, preferred shares, and equity or common shares. In the previous slide, we simplistically just considered debt and equity. Now we also take the intermediate category, which is preferred shares. The cost of capital is really a weighted average of the cost of capital from these three sources, and that is expressed through this equation. Weighted average cost of capital is equal to the weight of debt. So if a given company has raised a total of 100 million, of which 20 million comes from debt, then the weight of debt is 20 over 100, which is 0.2. Let's say that the company is paying an interest rate of 10% on this debt, then the cost of debt would be 10% or 0.1. The interest paid on debt is tax deductible, so we multiply by 1 minus t, and I'll discuss this in more detail later. So we then multiply this by 1 minus the tax rate. Say the tax rate is 40%, so we multiply by 1 minus 0.4. We do this because interest payments are tax deductible, and we'll discuss this in more detail later. Next, we come to preferred shares. Let's say that of this total capital of 100, preferred shares represents 30%. We therefore have a weightage of 0.3, and let's say the cost of preferred shares is 12%. We multiply by 12% or 0.12, and finally we have the weight of equity or common shares, which then becomes 0.5 multiplied by the cost of equity. If that is 15%, this is then multiplied by 0.15. What we have done here is taken the weighted average of the cost of these different sources of capital. That's why we call this term the weighted average cost of capital. You will also see this term marginal, and as indicated before, marginal means additional. When we are talking about the cost of debt or cost of equity, we are really concerned with the cost of raising additional debt or raising additional equity. Don't get too confused by this term marginal, though it doesn't really change the calculations that you need to do. Let's do a simple example. IFT has the following capital structure: 30% debt, 10% preferred stock, 60% equity. You are given the before tax cost of debt, which is 8%. You are given the cost of preferred stock and the cost of equity. The marginal tax rate is 40%. What is the weighted average cost of capital? Here is what you should come up with: 11.44%. And we are simply using the formula that we saw on the previous slide. This is an extremely important formula, so you need to know it well. The weight of debt into the cost of debt times 1 minus the tax rate plus the weight of preferred shares into the cost of preferred shares plus the weight of common shares or equity times the cost of equity. Here is another important example. Pause the video and do this before you look at the answer. The correct answer is B. You are given lots of numbers, but the main point is that when you make a capital budgeting decision, you need to compare the investment return with the cost of capital or the weighted average cost of capital. If the IRR is greater than the WACC, then you go for the project. If the return is less than the WACC, then you do not go for the project. Here, the weighted average cost of capital is given as 7%, so that is what you consider. Coming now to taxes and cost of capital. You will notice from the formula that we just discussed that we only consider taxes when we deal with debt. We do not consider taxes when we are talking about the cost of preferred shares or the cost of equity. The reason is that the money paid to preferred shareholders or the money paid to common shareholders is not tax deductible. the dividends do not reduce the tax payments of a company. That's this first point. Interest payments, however, are tax deductible and they reduce the tax that a company needs to pay, which means that they provide a tax savings. So the 1 minus t that we saw in the expression on the previous slide has to do with the fact that we have this tax saving. In general, whenever you have a cost of debt, you are going to multiply it by 1 minus t to represent that tax saving. What I'm going to do on this slide is explain to you why we multiply by 1 minus t. You just need to understand this once in your life, and then after that you simply use this expression. Let's say we have a company which has debt equal to 100. The interest rate is 10% and the tax rate is 40%. An interest rate of 10% means that the company is actually paying an interest amount of 10 to the lender. Let us do two calculations. On the left, we assume that the interest payment is tax deductible. This is the normal scenario. This is what happens in most countries. And just to illustrate a point, we will also do a calculation assuming that interest is not tax deductible. If you look at the left side of the screen, we have a simple income statement. Revenue is 100, operating expenses 50, interest is 10. Interest is tax deductible, so it reduces the EBT amount. The EBT is 40. The tax is paid against 40. If the tax is 40%, then the tax expense is 16 and the net income is 24. On the right, we assume that interest payments are not tax deductible. So you calculate a EBT of 50. The tax expense here is 20. Notice that 20 is 4 more than the tax expense on the left. And then obviously the net income is 4 less than what we have on the left. The point here is that because interest is tax deductible, it is reducing our taxes. So effectively, the cost of debt isn't 10, it is actually only 6. We do pay 10, but we save 4 in taxes. So effectively, the cost of debt is 6, or with this simple example, that represents 6%. And you will now see how this formula works. The RD represents the before tax cost of debt, which is 10%, and then we multiply by 1 minus t. Tax rate is 40% or 0.4, so you multiply by 1 minus 0.4 and you are left with 6%, which is what we see here anyway. After tax cost of debt is before tax cost of debt into 1 minus the tax rate. Do example 2 from the curriculum. That is a simple illustration of this concept. Coming now to the weights of the weighted average. We have talked about the weight of debt times the cost of debt, and then the weight of equity into cost of equity. Let's take a simple scenario where we don't have any preferred shares. How do you come up with these weights? From a testability perspective, there are 2 key points to remember. If you are given both book value and market value for debt and equity. So if we have book value of debt is 20 and market value of debt is also 20, but with equity, let's say that the book value is 40, but the market value is 80. So what are the weightages that you use? Answer is that you have to use market values, because market values represent the economic reality. So simple point, use market values when you come up with the weightages. The other point is that when you use weightages, you need to consider the target capital structure. Capital structure refers to the relative proportion of debt and equity. If a company has a current capital structure where debt is 10% and equity is equal to 90%, but the target capital structure based on announcements made by the company is as follows: debt 20% and equity 80%, then in your weightage you need to use the target capital structure. The reason is this: we are using the weighted average cost of capital for decision making. If the company has announced that its target capital structure is 20/80, then when it raises new capital, it will raise capital in this proportion. And obviously, when we are comparing the return on a project that we'll do in the future, it needs to be compared with the cost of capital based on the proportion that the company will actually be using. In any case, point to remember: when given a choice between current capital structure and target capital structure, you need to use target capital structure in coming up with the weights. Practically speaking, there will be situations where you as an analyst do not know the target capital structure. So what do? The simplest thing is to use the current capital structure, assuming that the current capital structure represents the target capital structure. Another strategy is to look at the trend. If you are noticing that the company is increasing its level of debt, you can use your judgment and the trend that you are observing to come up with the target capital structure. That is subjective, but not a very critical point from an exam perspective. Or you can use the average of comparable companies. And this is illustrated well in example 3. It is a somewhat long-winded example, but the concept is very straightforward. This should be a really simple example given that we've just talked about the subject matter. You gather the following information about the capital structure and before tax component costs for a company. You are given the tax rate, what is the cost of capital. The key point here is that you are supposed to use market values. So to do a cost of capital calculation, which hopefully you are getting comfortable with, we need to come up with our weightages and then multiply by the component cost. Here is what you should get. Marginal cost of capital and investment opportunity schedule, or IOS. What we are looking at here is the marginal cost of capital, which is the red line, and the investment opportunity schedule, which is the blue line. The marginal cost of capital we have already talked about. As we raise additional amounts of new capital, the cost of capital goes up. The way you can think of this is as follows. If you go to a bank and borrow money, there will be a certain rate. As you try to borrow more and more money, the riskiness goes up. So the cost of borrowing will go up. The same goes with equity. As you try and raise more and more money, the riskiness potentially goes up and the cost goes up. So simplistically put, as we try to raise more money or more capital, the cost of capital goes up. The blue line represents the investment opportunity schedule. Clearly, when you do projects, you will first do the high profitability or the high IRR projects. Therefore, with the initial amount of money that you have, notice that the return is going to be high. You then do projects that still have a decent IRR, but where the return is relatively less. And therefore, the investment opportunity schedule is downward sloping. The optimal capital budget is given by the intersection of these two lines. If you are at this point over here, then the return that you are getting on your projects is greater than the cost of capital, and that means that you are adding value. The NPV of doing these projects is positive. So it makes sense to keep going. As long as you are to the left of the optimal capital budget, it makes sense to raise new money and do projects because the return is more than the cost, so the NPV is positive. To the right of the optimal capital budget, the return represented by the blue line is less than the cost, which means that NPV is negative, so it doesn't make sense to be on the right of the optimal capital budget. And therefore, this point represents the optimal capital budget. Role of WACC, or weighted average cost of capital. The important points are written over here, so I will simply read them. For average risk projects, we should use the weighted average cost of capital to compute NPV, and this is what we did in the previous reading on capital budgeting. Adjustments to the cost of capital are necessary when a project differs in risk from the average risk of a firm's existing projects. The discount rate, or the WACC, should be adjusted upwards for higher risk projects and downwards for lower risk projects. This is fairly self-evident.